Hi, everyone, and welcome to the Loomis Capital Podcast. I'm your host, Max. Today, we have a packed episode looking at how easing inflation is helping households regain some financial stability and manage their debt more effectively. We'll break down key insights, explore the economic shifts that impact debt management, and hear from experts on the best strategies for dealing with high-interest obligations. So sit back and let's dive in. In the third quarter of 2024, we've seen some notable progress in managing credit card debt. U.S. credit card balances have hit a record $1.17 trillion, which is an increase of $24 billion. Despite these high levels, there's some good news. Delinquency rates have started to ease up. As inflation slows, consumers are finding a bit more breathing room to handle their finances. Let's take a closer look at some key insights into consumer debt. First off, total U.S. credit card debt is now at $1.17 trillion as of Q3, showing a $24 billion rise from the previous quarter. However, the share of credit card debt that's 30 days delinquent has dropped slightly to 8% from over 9% last quarter. This indicates a small but significant improvement. Easing inflation is giving households a bit of financial stability, making it easier for them to manage their credit obligations. Softer inflation, along with tightened credit standards, is providing consumers with a unique window to tackle high-interest debt. So, what's driving these changes? Consumer debt patterns are closely tied to inflation and overall economic conditions. As inflation cools down, household budgets are seeing some modest improvements, allowing consumers to prioritize debt repayment better than before. For instance, credit card balances increased by 7% year over year in Q3, which is a significant slowdown compared to the 15% rise we saw in 2020. Additionally, lenders have become more stringent, tightening their criteria to reduce the pace of new debt accumulation. Lower inflation also means restored purchasing power, helping households balance their spending and debt payments. It's a good time for a proactive approach to manage credit effectively. While the signs of improvement are encouraging, let's not forget that overall consumer debt, including mortgages, auto loans, and student loans, continues to rise. This shows that financial stress is still a significant concern for many households. Even though delinquency rates have improved slightly, they remain historically high, presenting ongoing challenges. Focusing on high-interest debt like credit cards is crucial for making impactful financial progress. Managing multiple types of debt in an environment where costs are rising requires disciplined financial planning. So, if you're dealing with high-interest credit card balances, paying those down first can offer immediate financial relief and reduce long-term costs. Financial experts agree on the importance of disciplined credit management, especially during this period of easing inflation. One strategist remarked, "Inflation is finally giving consumers a break, but addressing high-interest debt now is crucial to avoid falling back